Welcome to Talk Tickers, your deep dive into the latest earnings calls.
Today, we're digging into Capstone Green Energy, ticker CGEH.
That's right. Their Q1 fiscal year 2026 call just wrapped up on August 15th.
And our job, as always, is to pull out the key takeaways, the big moves, and what it all might mean going forward.
Basically cut through the noise for you.
Exactly. And Capstone. Well, they're an interesting one. They've been on this journey, sort of post-restructuring, trying to find stable footing.
Moving from just surviving to what they're now calling profitable growth.
Yeah, and this call gave us some pretty strong signals about whether they're actually making that turn.
Okay, so let's start with the snapshot then. The Q1 numbers. How did they look?
Pretty robust, actually. A strong start to their fiscal year. Total revenue hit $27.9 million.
Which is, what, compared to last year?
A huge jump, 78% increase year over year.
Wow, okay. 70%. What drove that?
Well, it was really two key areas firing. Systems revenue, that their product sales, was up nearly 190%.
190. Okay, that's massive. Must have been a big order in there.
Definitely, we'll get to that. But also their energy as a service, or EaaS revenue, that was up a strong 77% too.
Right. EaaS, that's their recurring revenue stream, rentals, services. Super important for stability.
Exactly. So growth across both sides of the house, which is, what you want to see.
And what about the bottom line, or at least operating profitability?
That's maybe the bigger story here. They notched their fifth consecutive quarter of positive adjusted EBITDA.
Fifth straight quarter. Okay, that feels significant. How much was it?
$2.7 million for Q1. And that brings the total over those last 5 quarters to over $10 million in adjusted EBITDA.
Which, for them, historically, that's a big deal.
It really is. And gross margin also expanded nicely, up 300 basis points to 27%.
So 3 full percentage points better margin. That helps profitability a lot.
Definitely points to better pricing or efficiency, or likely a mix of both.
Okay. Strong, top line, consistent adjusted EBITDA, better margins. But is there a catch? What about actual net income or cash flow?
Yeah, good point. Despite those operational improvements, they still reported a net loss of about $2.7 million.
Okay.
And operating cash flow was negative $1.6 million. Cash on hand ended at $6.6 million.
So still burning some cash as they grow and manage things like inventory and receivables.
Exactly. Investing in that growth, handling working capital swings, it paints a fuller picture.
Got it. And how did the market react on the day? Did the stock pop?
It was modest. Finished up about 2.0% on the call day.
Only 2% with those numbers. Why so muted?
Well, you got to remember, CGEH is an OTC-listed microcap. Liquidity is thin.
Right. Harder to trade, fewer big institutional players, maybe?
And the stock had actually seen a pretty sharp run-up before the earnings came out.
Ah, okay. So some of the good news might have already been priced in, coupled with those microcap dynamics?
Precisely. A positive reaction, but yeah, nuanced.
Okay, so those are the headlines. Let's peel back the layers now. What's really driving this performance? Start with that huge systems revenue jump.
Yeah, that was largely down to one big delivery. A 6-megawatt order for a microgrid project out in California.
6 megawatts? That's a chunky piece of business. Shows they can handle big projects.
Absolutely. It does make that systems number a bit lumpy quarter to quarter, but it's a great proof point.
And the EaaS growth. 77% is nothing to sneeze at either.
No, that was driven by better utilization rates, keeping their rental fleet busy, and stronger market pricing.
Interesting. Where's the demand coming from?
Particularly strong demand, they noted, from the oil and gas sector for rentals.
Oil and gas, that seems a bit counterintuitive for a green energy company, no?
Well, it shows market diversification, right?
Uh-huh.
Their tech can provide reliable power in remote locations, which that sector needs. It adds resilience to their revenue mix.
Okay, makes sense. Let's talk profitability drivers then. That 300 basis point margin expansion, how they achieve that?
Management pointed to a few things. One was a favorable sales mix, selling more high-margin stuff. 2, strategic price increases that actually stuck. 3, those better utilization rates we mentioned.
And 4.
Ongoing efforts in what they call DFMA design for manufacturability and assembly. Basically engineering things to be cheaper and easier to build.
Right, those continuous improvement initiatives. So It wasn't just one thing, but a combination.
Exactly. And that 5-quarter streak of positive adjusted EBITDA, they tie that back to their 3-pillar strategy.
Which is?
Financial health, sustainable excellence, and culture. It sounds a bit like corporate speak, but the consistent results suggest there's substance behind it. They're aiming for sustained profitability now, not just hoping for a good quarter here and there.
Okay, so this feels like a deliberate effort to build a fundamentally more profitable business.
That's the narrative they're pushing, and the numbers, at least on the adjusted EBITDA front, are backing it up for over a year now.
You mentioned financial health as a pillar. Let's look at the balance sheet a bit closer. Cash was down, you said.
Yeah, due to operations and working capital, but they did highlight accounts receivable, that's money owed to them, which stood at $10.7 million.
Is that a worry? Are customers not paying?
Management said over 90% of that was current, meaning not overdue. They attributed the high balance to the timing of those large sales, like the California project. So seems more like a timing issue than a credit issue, based on their comments.
Okay, that's important context. And inventory.
Declined slightly. They pointed to supply chain efficiencies there, better management.
And the D word, debt. Always a key focus for growing companies.
Yep. They have about $8 million in short-term debt coming due around December 2025.
That's not insignificant compared to their cash balance. Are they going to be okay?
Management expressed high confidence in addressing it. They said they have multiple efforts underway. Hitting that target is definitely a key near-term financial objective for them. It would de-risk things quite a bit.
Okay, something to watch closely over the next few quarters then.
Absolutely. Now let's shift gears a bit to strategy, because there was a really big strategic move they discussed.
Oh, yeah.
What was that? The acquisition of their big Western U.S. distributor, Microturbine. They're calling it Capstone West now.
Ah, bringing distribution in-house for a key region. That is a big deal.
They called it a fundamental shift in their business model. It covers states like California, Hawaii, Nevada, Oregon, Washington, really important markets for them.
Why is that so fundamental? What's the advantage of going direct?
Well, first, it's expected to be accretive add to gross profit and EBITDA pretty quickly.
How?
Because now they capture the entire value chain in that region. No distributor markup in the middle. They get 100% of the revenue and associated profit from sales and service there.
Right, makes sense. Better margins.
Better margins plus direct access to the customer. They can build those relationships, understand needs better, and potentially accelerate growth, especially in those high-demand areas like microgrids.
So it's a shift away from relying purely on distributors.
In that specific, very important region, yes, a hybrid model now. They even mentioned Goldman Sachs helps support the transaction, which adds a bit of financial credibility.
And how's the integration going? Bringing a whole distributor team in-house isn't always smooth.
They described it as smooth and positive so far. Key leaders from Microturbine, Tracy Chibitin, and Ray Shaw are leading the Capstone West operation.
And why is that region so critical? You mentioned California, Hawaii.
It's kind of a perfect storm for Capstone's offerings. You've got sky-high electricity prices, really aggressive clean energy goals, like California aiming for net zero by 2045.
Plus those public safety power shutoffs during wildfire season.
Exactly. Creates huge demand for energy resiliency. And then you have leading incentive programs like California's SGIP that help fund these kinds of microgrid projects.
So tons of built-in demand drivers in the territory they just acquired direct control over.
Precisely. Strategically, it looks like a very smart move to capture more value from their most promising market.
Okay, great strategy on paper. But can they execute? Can they build enough product to meet potentially surging demand, especially if they land more big projects?
That's the million-dollar question, right? And they spent some time on the call addressing operational capacity and innovation.
What did they say?
Get this. They're currently operating at only about 12% of their potential first shift manufacturing capacity.
12%? Wow. So they have a ton of room to grow production without building new factories.
A massive amount. They're actually doing a lean floor relayout right now, led by their VP of Ops, John Tour.
Okay.
And they project this will allow them to scale up to potentially 400 megawatts of production capacity over 3 shifts.
400 megawatts, that's a lot.
It is. And crucially, they said with minimal additional capital expenditure. That's huge leverage. They can ramp up significantly without breaking the bank.
That is a serious advantage if demand really takes off, especially for things like data centers needing lots of power.
Definitely. And speaking of efficiency, they highlighted one of those DFMA projects, redesigning their battery enclosure.
The cost-saving initiatives you mentioned earlier.
Right. They got the unit cost down from $900 and $350.
Wow, that's a 61% saving. How?
Global sourcing, optimizing logistics, simplifying the design. And they said phase 2 is planned for even more simplification It just shows that relentless focus on chipping away at costs.
Which flows right through to gross margin.
Exactly. And on the innovation front, they're dusting off an old prototype, the C250.
C250, what's the plan there?
They're reassembling the development team to work on new designs based on it, specifically targeting 2.5 megawatt building blocks.
Why 2.5 megawatts?
Seems particularly relevant for data centers. A typical data hall might need 10 or 12 megawatts, so these larger blocks make scaling easier.
Smart. Targeting a high-growth, power-hungry market segment.
Seems like it. They also touched on tariffs mentioned about a $400,000 impact this quarter.
Ouch. How are they dealing with that?
Dual and triple sourcing strategies for components, building resilience, trying to navigate those shifting trade policies, shows they're being proactive.
Good. And one other operational thing they mentioned.
Yes. Their rental unit strategy. Because they make their own microturbines, they can actually build rental units using parts from decommissioned machines.
What kind of means?
Much better margins on those rentals compared to competitors who have to buy equipment from someone else to rent out. It's a neat competitive advantage in that EaaS segment.
Okay, controlling more of their destiny on the cost side there too. Let's look forward then. Market outlook, guidance, investor stuff. What do they say about the rest of the year?
Well, their trailing 12-month revenue, TTM, is just over $97 million right now.
Okay, almost at that 100 million mark.
And they explicitly said they expect to achieve over $100 million in revenue for the full fiscal year 2026.
So they're guiding for continued growth. What gives them that confidence?
A larger order pipeline, they said, and improving pricing trends.
Where's the demand coming from specifically?
Continued strength expected in those oil and gas rentals, core commercial and industrial customers, plus that growing interest in microgrids and potentially data centers.
Any other potential catalysts?
They did mention potential tax law changes. If businesses get accelerated expensing for buying their own power generation, well, that could be a significant demand driver. Makes the payback period much faster for customers.
Interesting angle. And how are they managing this growth, keeping track of the pipeline?
They've implemented a new pipeline management tool. Sounds like
Right.
They're trying to bring more discipline and better forecasting to the sales process.
Good. And what about engaging with Wall Street, getting more visibility?
They're actively talking to several analysts, hoping to get research coverage reinitiated. That would be a big step for a microcap like them.
Absolutely. Analyst coverage brings eyeballs, potentially more institutional interest, better liquidity.
Right. They're also planning to attend the Roth conference in September, kicking off a broader investor roadshow, webcasts, lunch and learns, that sort of thing.
Trying to tell a story more widely.
Yeah, and also working on getting the stock uplisted to the OTC QX market tier and making sure the ticker symbol actually links to the correct company name, which apparently Funera has now corrected. Just basic blocking and tackling for investor relations.
Okay, so pulling it all together, what's the big picture takeaway for an investor looking at Capstone right now?
I think this call really reinforces that narrative arc we talked about up front, moving from just stabilizing after restructuring to actively pursuing profitable growth.
It feels like a pivot point.
It does. A pivot from just selling through distributors to taking direct control in key markets, like with Capstone West. A pivot from, hitting positive EBITDA occasionally to doing it consistently for 5 quarters straight.
And a pivot from being just a microturbine company to positioning themselves as a broader energy-as-a-service microgrid platform provider.
Exactly. Aligning themselves with those big megatrends: energy resilience, decarbonization, distributed generation.
So key things for you, the listener, to watch going forward.
Definitely the integration of Capstone West as it delivered the expected profit boost. Second, resolving that $8 million in short-term debt by December. That's crucial.
And third,
Getting that sell-side analyst coverage initiated, that could be a major catalyst for visibility and potentially re-rating the stock.
and of course, the next earnings print. Will they stay on track for over $100 million in revenue? Will those gross margins hold up?
Those are the proof points the market will be looking for.
All right, that brings us to our not financial advice segment. And let me just say it loud and clear. Everything we discuss here is purely for informational purposes. It is not financial advice. Investing carries risk. Always do your own homework.
Got the disclaimer out of the way.
Check. So, given everything we've heard about Capstone's Q1 and their trajectory, what's an outrageous but plausible trade idea?
Okay, here's one. You go long CGEH. You're betting on a significant re-rating of the stock.
Okay, going long, what's the outrageous part?
The magnitude of the potential re-rating?
No.
You're betting they not only hit that $100 million plus revenue target for FY26, but they also successfully get analyst coverage, maybe even spark a bit of a short squeeze if institutions start noticing. The dream scenario is this propels them off the OTC and towards a major exchange listing eventually.
That would be a huge move from where they are now.
Yeah.
Definitely leans towards outrageous. What makes it plausible?
The plausibility rests on the execution we've seen. The 5 quarters of positive adjusted EBITDA show operational discipline is taking hold. That massive untapped manufacturing capacity, only 12% used on first shift, potential for 400 milliW, means they can scale dramatically.
Plus, the Cal Microturbine acquisition looks strategically sound.
Right, potentially very accretive. And the demand in microgrids and data centers is undeniably real and growing fast. If, and it's still an if, they execute on resolving the debt and landing that analyst coverage.
Then the market's perception could shift really quickly.
Exactly. The idea is you recognize the operational turnaround before it becomes obvious and widely followed. That's where the potential reward lies, balancing the clear risks.
Interesting. An outrageous but plausible scenario indeed. Okay, let's wrap this up.
To recap, Capstone Green Energy laid out what sounds like a pretty compelling story on this call. Strong growth, improving and consistent profitability, smart strategic moves into key markets.
There's a clear focus on execution, accountability. They even used the term badass culture on the call, needing to be relentless.
Yeah, positioning themselves to grab those opportunities in distributed generation and microgrids, which are definitely there.
So maybe the final thought for you listening is to consider how much operational execution and, dare I say, culture can matter. Even for a small company in a tough market, getting the fundamentals right can unlock significant value over time.
It makes you wonder, what's the next strategic step? Could they replicate the Capstone West model elsewhere? Where else could that huge manufacturing capacity be deployed if demand surges even faster? Food for thought.
Indeed.
Yeah.
Thank you for tuning into Talk Tickers for this deep dive.
If you have thoughts or questions on CGEH or anything we discussed, please do reach out. We'd love to hear from you.